Hi, everyone. We're going to give it another minute or two to wait as others are still joining.
I know people are still jumping on. This is Michael Wardy. Al, I know people are still jumping on. We may want to get started in
Sure.
the interest of the time.
Okay. Yeah, there's a lot of information to go over, so we're going to go ahead and get started. Thanks for joining us today. I'm Al Schmidt, and I'm your host, along with Michael Wardy. We will be discussing the current state of depreciation for commercial real estate in order to keep you informed on the various changes that we've had here recently and help keep you and your clients in the loop. Our presenters and their team have spent countless hours digging through the changes that have taken place, so you don't have to do that. There are some housekeeping items that we need to address real quick, and I'll have Michael Wardy go over that.
Thank you, Al. And thank you, everyone, for joining. I know we have a lot of information, so I'll keep my portion very short. As Al had mentioned, my name is Michael Wardy, Certified Financial Planner and Regional Director here at Source Advisors. And our housekeeping items is number one, this is for a 1 hour CPE credit. So throughout the presentation, we will be asking 4 polling questions. As long as you answer 3 out of the 4, we'll issue you your CPE certificate. If you have questions, please feel free to type them in the question section and we'll try to get to it. If we run out of time, don't worry about that. We will follow up with you afterwards with the answers and further discussions. Lastly, we've added a PDF of the presentation in the handout section that you can go ahead and download and have for your future reference. At this time, I'd like to introduce Charles Duncan, who is our Senior Technical Director here at Source Advisors and is one of the leaders of our cost segregation practice. Charles actually started our cost segregation practice in 2003. And with more than 20 years of cost segregation experience and having managed literally thousands of studies, he can say that he and his team have performed a cost segregation study on every type of building. With that, Charles, I'm going to turn it over to you to get started.
Thank you, Michael. Thank you, Al. If you could please progress to the first slide. All right, so the presentation we're giving actually is designed to have 6 parts that are interchangeable depending upon which audience we're speaking with. It's about an hour and a half worth of content. We're only going to be covering 4 of the 6 sections. So we'll talk about number 1, the CARES Act and its effects on bonus depreciation. So we'll discuss QIPP quite a bit in there. Secondly, we'll be talking about Section 179. Number 3, we'll talk about Section 163J. We will pass over the section having to do with 163J specifically for auto dealerships because this is a mixed group. And we will wrap up with a short discussion of Section 1031 real property. And most people probably don't want to refresh the tangible property regs in any case, so you're probably not going to miss that final section. So since 2011, we've seen a lot of significant changes that affect depreciation. And these changes, the significant ones, have been coming out roughly every 2 years. In December of 2011, we had the temporary TPRs introduced. In 2014, the TPRs were finalized. In 2016, we had the PATH Act, which introduced QIPP for the first time. Retroactively brought back bonus depreciation. And then at the tail end of 2017, we get the TCJA, which, as many of you know, as far as depreciation goes, was broken in many ways when it was delivered to us. And that leads us to the 2020 CARES Act, which amongst other things fixes those broken portions. What is often referred to as the retail glitch was repaired for QIP property. And then between all these, we have a whole bunch of rev procs and other guidance that, again, give us a really complex landscape as far as depreciation goes. Next slide, please.
Actually, Charles, we have our first polling question that I want to get in.
Oh, sure enough. Go ahead, please. Have you filed QIP amended returns or Forms 3115 yet? Please select one. Yes to both, only amended, neither, or not applicable.
We'll give it about another 15 seconds. And we'll go ahead and close out the polling now. And I'll share the results.
Yeah, so it looks like most people have selected neither. There isn't really a right or wrong answer to most of these polling questions. And that this is about what we expect, having looked at other, the results from other presentations. So with that, Michael, if you could move us to the next slide, which should be CARES Act and bonus depreciation. And one more slide, please. So it's impossible to talk about the CARES Act and the TCJA without discussing 15-year Q property. The TCJA had eliminated much of what was a very complex landscape of Q property prior to 2018. And we had 4 types of Q property: qualified restaurant property, qualified retail improvement property, qualified leasehold improvements, and then QIP, qualified improvement property, which had been introduced by the PATH Act. And these all worked in interrelated ways, sometimes in a very confusing manner. We had a whole presentation devoted just to this topic prior to the TCJA, and I loved being able to dance around the complexities of it. It made me look smarter than I really am, and frankly, there's a lot of opportunities that people would historically miss out on because of that complexity. The TCJA was trying to do something laudable, which, at least in this case, which was to simplify the Q property. And what they did is they eliminated the qualified restaurant, qualified retail, and qualified leasehold improvements. So after 2017, they just simply do not exist anymore for property placed in service after 12/31 of 2017. And QIP was meant to take on the responsibilities of all these other types of Q property. This is where the retail glitch came in. As most of you would know, the qualified improvement property was supposed to have a 15-year life, receive bonus depreciation, and qualify for Section 179. However, upon arrival with the TCJA, the bonus depreciation and the 15-year life were broken. They just didn't exist. And so we went through north of a 2-year period where we didn't have any sort of 15-year Q property, nor Q property receiving bonus depreciation. This was rectified by the CARES Act. And so if you look at the table here, in this table, you're looking at the history of Q property going all the way back to 01. The green cells indicate where provision applies to both new and used property, as well as to the entire building. That was something special about qualified restaurant property, where after 2008, the entire building could be qualified restaurant property, and it could be an acquisition or new construction. So you had these entire buildings of 15-year property. The orange cells indicate where the provision applies only to new interior improvements, and there was a 3-year rule that applied. And with earlier qualified restaurant property, as well as all qualified retail and qualified leasehold, that was true. Now, QIP doesn't have those, this exception or this 3-year rule. And with the CARES Act, it now has a 15-year life, and it receives, right now at least, 100% bonus depreciation. That will go down over time. In general, this is a very, very taxpayer-friendly provision, but there are some exceptions. And going back to qualified restaurant property, the days where entire restaurants could have a 15-year life are long gone. And this does affect certainly a lot of my clients, perhaps some of yours, who were accustomed to their whole real estate strategy being predicated on having that 15-year life. And it was not a mistake when that was eliminated. And as far as I know, I haven't heard any whispers of changing that. So the qualified restaurant property has taken a bit of a step back with the not only the CARES Act, but with the TCJA itself. Next slide, please. So what are the QIPP rules? The general rules dating back to 16 apply. QIPP property is new interior improvements placed in service after the original commercial building is placed in service by anyone. So it could be placed in service by the current taxpayer previously or a prior owner of it. As long as that building's been placed in service, even if it was last week, new interior improvements can be QIP. It does not apply to multifamily. So apartment complexes, nursing homes, dormitories never receive QIP. Additionally, QIP does not apply to elevators or escalators, nor to the interior structural framework of the building. So if there's a major remodel and the column grid is having to be shifted around for some reason, perhaps there's the addition of a new mezzanine within a particular volume of space, none of that would receive QIP treatment. But most other interior improvements would. We use RevProc 2020-25 to file Form 3115 or amend returns for post-2017 QIP. And then the table down below indicates a number of things. One is the overlap between the PATH Act rules and the TCJA. And we're not going to get into a whole lot of detail about this overlap in the presentation, but many people thought that the PATH Act rules disappeared as soon as the TCJA came into play, and it's not really true. We often find ourselves, at least in cost segregation, trying to determine whether a particular taxpayer and their property are falling under the PATH Act versus the TCJA, and it gets a little complicated. And that's true with the QIP as well. So you have your date range. The next column over is what type of bonus depreciation is received. And then QIP after 2017 qualifies for Section 179 for the first time, and it has a 15-year life. So when QIP was originally introduced under PATH Act, all it did was provide bonus depreciation and nothing else. Under the TCJA, it provides bonus depreciation thanks to the CARES Act, which fixed the retail glitch. It qualifies for Section 179 and also fixed by the CARES Act. It has a 15-year life. And this is what was intended originally in the TCJA. Next slide, please. The IRS considers treating QIP as 39-year property an impermissible method of accounting. Now, that's despite the fact that for well over 2 years, most of us were treating it as QIP property because that was technically the legally correct way to treat it under the TCJA until the retail glitch was fixed. So now that it has been fixed, we need to go about changing that. And one way of thinking about this, when we perform a cost seg study on a property that was placed in service previously, the reason we're able to file a 3115 is because, technically speaking, having the entire building as 39-year property is an impermissible method, that it correctly should be broken out between 39, 15, 7, 5-year property, or 27.5-year property if it's multifamily housing. And this is the kind of the same thing we're seeing here. Technically, it's incorrect to keep the QIP as 39-year property. Finally, due to less favorable Section 1245 recapture rules, if the building improvements that should be Section 1245 property are treated as QIP, the IRS may reclassify it in the year of sale. So something to keep in mind. We haven't seen this happen yet, but there's that potential out there. So with these incredibly generous QIP rules, is there a need for cost seg on renovations of existing buildings, on tenant improvements? Well, arguably yes, if enough money is being spent and the work is complex enough. With simple projects, it is possible to go ahead and identify everything as QIP on your own. If you have good invoice detail, you might be able to pick out the 1245 property easily enough and treat the rest as QIP if nothing structural is done and there's no work on elevators and escalators. But when we start looking at more complex renovation projects, it still might be really useful to bringing someone to perform a cost seg study. So depending upon the quality of the costs, you may or may not have structural changes that are non-qualified for QIP broken out. And so we would kind of do a reverse cost seg where we identify what doesn't qualify. Elevators and escalators don't qualify. And so trying to, make sure those are carved out properly would be the appropriate thing to do. However, sometimes there is work that's performed inside the elevator. For instance, the insides might be remodeled, altering the floor coverings and the walls, for instance, the wall finishes. And you see this a lot in hotels, which are constantly having to, fix up their elevators. That sort of work might very well qualify, even though anything else elevator related would not. Another point is that not all enlargements of buildings are excluded from the QIP definition. You may have a scenario where you're increasing the internal square footage of the building, but you're not changing the volume of the building. And an example of this would be the creation of a mezzanine inside of an existing space. We see this a lot with auto dealerships, where they'll build mezzanines within the existing space to get more storage space in their parts department, if that was something they hadn't planned originally when the building was constructed. You're increasing square footage without increasing volume. And when you start doing that, these enlargements may not necessarily, they play around with this definition of QIP, what's proper, what's not, and that's worth looking at. And I already mentioned the internal structural framework is not QIP, so we need to carve that out. And that's independent of the motivation for that work. So for instance, interior earthquake related improvements, they are pretty much inherently structural in their nature. And it doesn't matter that someone else is making the property owner perform this work, it's still considered structural and would not be QIP. Michael, next slide, please. So let's get into the bonus depreciation rules. And some of this is water under the bridge. Most of us should be caught up on significant portions of this at this point. Property acquired and placed in service after 9/27 of 2017 may qualify for 100% bonus. Beware the binding contract and work of significant nature rules. Not everything placed in service after 9/27 of 17 qualifies for 100% bonus. And we'll cover that on a later slide. Bonus drops to 80% in 2023, and it drops an additional 20% every year until it's eliminated in 2027. The original use requirement was removed for property placed in service after 9/27 of 17. So bonus now applies to purchases of used as well as new items. It does not apply to property received as a gift or from a decedent. This removal or elimination of the original use requirement has been a real boon to us who perform cost seg studies. About 50% of the work we do are look back studies, are acquisitions, and now all those acquisitions are could qualify for bonus depreciation, which is good news for our clients. In general, for like-kind exchanges or involuntary conversions, bonus depreciation applies only to the excess basis. For example, the money put into the deal to trade up. If the replacement property is original use, both exchange and excess basis can qualify for bonus. And bonus does not apply to property acquired in a non-taxable exchange, such as a reorganization, property acquired from a member of the taxpayer's family, another related entity is defined in Section 267, nor to property acquired from a person who controls, is controlled by, or is under common control with the taxpayer. It does not apply to property used in certain utility trades or businesses. And it sounds like there's a bunch of exceptions here, but in reality, the current bonus depreciation rules are the most generous that we have ever seen. And most of my clients are certainly qualifying for bonus one way or another. Next slide, please. Okay, so this table gives us an illustration of what bonus depreciation looks like since 2011. Obviously, bonus goes back as far as 2001, but nobody wants to read the fine print if I have to put all that onto a slide. This gives just a general flavor of what we're talking about. So again, on the far left, we see that there's overlap between the TCJA and the PATH Act. There is work that was placed in service in 2018, after the TCJA is already in place, that is still technically receiving bonus under the PATH Act rules. And this is because of the binding contract rules and work of significant nature that help us look at these transitional periods. And again, we'll come back to that on another slide. But there is this overlap between when the TCJA rules apply in a particular instance versus the PATH Act, and we have to apply a magnifying glass to it to figure out what's what. So, we have a column for the date ranges, and then what bonus was prior to the TCJA. So most recently, that was the PATH Act, where we had 50% bonus that had a tail that stepped down to 40% and 30% and would phase out at 2020. TCJA bonus starts off at 100%, and it's not until 2023 that it starts to fade out at 20% per year until it's eliminated in 2027. Then the remainder of the 5 columns are types of property that may or may not receive bonus. So first of all, Section 1245 property and land improvements, they always receive bonus in those years in which we have bonus depreciation. The orange cells indicate where that applies only to original use property, and the green cells, is where the bonus applies to both original use and non-original use property. So we see that with the introduction of the TCJA. Qualified restaurant and qualified retail property have never ever qualified for bonus depreciation, at least on their own merits. They would only qualify for bonus if they were also coincidentally qualified leasehold improvements prior to 2016 or QIP after 2016. And so that's why you don't see any shading on those 2 columns. There's a red ellipse or whatever you want to call it that's in the middle of the slide. And this is kind of the magical sweet spot where we're getting the best of all worlds. We're getting QIPP property that has a 15-year life. The original use rules have been eliminated, and we're receiving 100% bonus depreciation for QIP, as well as the Section 1245 property and the land improvements. So that's really kind of our sweet spot as far as bonus goes. Next slide, please. Okay, this is the ugliest slide in the presentation, and I mean that in terms of the content and not how it looks. I'm actually kind of proud of this. Whether or not an expenditure qualifies for 100% bonus under the TCJA or 50, 40, or 30% bonus under the PATH Act is based on this idea of when was the binding contract written, when was work of a significant nature, and when was the placed in service dates. And these rules have been with us ever since bonus was originally introduced after 9/11. Many of us, if not most of us, had forgotten about them because we had so many consecutive years of 50% bonus that as we moved from one piece of legislation to another, there's new tax extenders here or there. It didn't matter. We were always getting the right answer. There were occasions where we didn't have bonus, but it was retroactively brought back in a way that suddenly became seamless. And so for many years, we got the right answer, even though we didn't really know why we had the right answer. It was just very difficult to get it wrong. So when we're looking at bonus, particularly in that period of late 2017 and into 2018, less often in 2019 or 20, there's this transitional period where you have both the PATH Act and TCJA laying on top of each other. So let's look at the top three examples here. And specifically, I'm going to look at the third one that has a TCJA next to it. These top three examples are for non-original use property. So acquisitions is something that was placed in service previously by someone else. And when we're talking about acquisitions, what we're really looking at are two variables. When was the binding contract and when was the placed in service date? And this is really straightforward. If the binding contract is after 9/27 of 17, obviously the placed in service date is as well, and that acquired non-original use property would receive 100% bonus depreciation. Any other scenarios, such as the two above that, it doesn't receive bonus at all. So binding contract and placed in service date, both after 9/27 of 17, it gets 100% bonus. It's in the TCJA. Now, for what we call self-constructed property, which is a building, things are a little bit different. We have the binding contract, we have this other variable, work of a significant nature, and the placed in service date. And there's been a lot of vacillating over the last 2.5 years as the service tried to figure out how they wanted to interpret what had been a very traditional understanding of this. So prior to the TCJA, we really ignored the binding contract and only looked at work of significant nature and placed in service. And what's work of significant nature is, it's asking us, has more than 10% of the actual physical work occurred on the property? So not designing, not architecture fees, engineering, permitting, all that, but the actual work. And there's a safe harbor. As long as less than 10% of the work occurred prior to the cutoff date, which means prior to 9/28, then you would be under the TCJA. And then we looked at the placed in service dates, and determine what type of bonus, which right now would be 100%. But there was a lot of vacillating background about whether or not we would still have this interpretation under the TCJA. And there was proposed bonus depreciation regs over a year ago that put this into doubt. However, the new finalized bonus depreciation regs have reinforced this idea. So we can now look at only work of significant nature and the placed in service date for making those determinations. So if less than 10% of the work on an asset occurred prior to 9/28 of 17, you're in the realm of the TCJA and would qualify for 100% bonus. If more than 10% occurred before that, you're under the PATH Act and would look at the phase down for bonus based on your placed in service year to determine what you get. Next slide, please.
Actually, Charles, we're gonna do a quick polling question.
Oh, are we already there? I'm sorry. Yeah. Let me back up real
Do you want me
quick.
to pause that?
No, that's fine. Yeah, you're good. I just didn't expect the polling question right there. That's fine. So, are you looking forward to filing 3115s for buildings under construction on 9/28 of 2017? Please select one. Yes, no, must have dozed off, or not applicable. And we'll give you 15-20 seconds to fill that out, please.
And like Charles said earlier, there is no right or wrong answer. There is one funny answer, though.
That's right.
All right, we'll give another couple seconds. A couple are trickling in still. And we'll go ahead and close it and share the results.
So most people said no, and we had some honest people who said they must have dozed off, which I appreciate. I'm throwing a lot of words and concepts at you. My feelings are not hurt in any way, shape, or form. All righty, Michael, if you can move on to the next slide. All right. So TD 9916, an advanced copy was issued on 9/21 of 2020. With some modifications, these regulations finalized the proposed bonus depreciation regs that were issued 1 year ago. With certain exceptions, which including early application, the regulations are applicable for property acquired after September 27th of 2017 and placed in service during or after a taxpayer's first taxable year, beginning on or after January 1st of 2021. And hopefully the bonus rev proc will be issued by mid-November. I think we're getting a little north of that, or by the end of the year at the latest. That's what we were told to expect. Next slide, please. So what has changed under TD 9916? The rule prohibiting a dealership from foregoing floor plan financing interest deductions to get below the section 163 little j cap and claim bonus depreciation remains. If a taxpayer took this approach, transitional guidance to fix it will be issued in the near future. In a section 168 little I 7 cap B transaction, if a transferee acquires QIP placed in service by the transferor, the transferred basis will qualify as QIP in the hands of the transferee. So in other words, if I buy something from you and you've been treating it as QIP, it's QIP for me too. However, it will not qualify for bonus depreciation. That elimination of the original use rule doesn't apply when it comes to QIP because the QIP rules specifically say that it needs to be new to the current owner, the current taxpayer. The de minimis use rule has been clarified to consider additional factual situations involving placing in service an asset, disposing of it to an unrelated taxpayer, and reacquiring it. Next slide, please. Okay. The partnership look-through rule was withdrawn without replacement. Partners will no longer be treated as having owned partnership property in their role as a partner. The related party rule of section 179 and the series of related transactions rule will prevent abuse. The series of related transaction rule has been simplified. Under the new rule, each transferee will test its relatedness with the immediately prior transferor and the original transferor. Corporate stock sales treated as an asset due to section 336 little e election will be treated the same as section 338 elections. At this point, I should apologize that I am reading directly from the slides. It's just this particular content, it's hard to do anything other than that. We'll get to a little more interesting content momentarily. Finally, on this slide, the new component election providing more generous bonus depreciation opportunities for components of larger property that was under construction on September 28th of 2017. This new component election is actually really important. When I was talking a couple slides back about the placed in service acquisition rules and talking about that second variable, work of a significant nature, has more than 10% of work of significant nature occurred, and you're either in the PATH Act or the TCJA. The traditional way of looking at that was that it applied on a building by building basis. So the whole building is basically kind of your unit of property or asset for purposes of applying those those rules on whether or not you qualified under the TCJA or the PATH Act. What this new component election is allowing us to do is look at contracts or components within the broader construction contract. And so, I would look at concrete work separately from masonry, which should be separate from my interior finishes, my carpeting, my vinyl wall covering, et cetera. This would be separate from the electrical, et cetera. And this means that portions of your building might be under the PATH Act and receiving PATH Act bonus, while other portions would be under the TCJA and receive the greater TCJA bonus. And to further illustrate that this is actually good news, when you're constructing a building, you generally begin with the concrete and the masonry, the earthwork, things of things of nature that don't get bonus anyway. And most of what does qualify for bonus is installed later on in the process. So you may have busted out of that 10% work of significant nature safe harbor, and yet virtually everything that you were hoping to apply bonus to under the TCJ might still get it, because that work is being performed after 9/27 of 2017. And we actually went back and had to review the better part of 1,000 studies to see where that was the case when the CARES Act came out and the final, when these final bonus depreciation regs came out, to make sure that we didn't miss any opportunities where a client could have had 100% bonus as opposed to 50% or 40% or 30% under the PATH Act. Michael, next slide, please. Section 179 update. This is straightforward, and there weren't really any changes to 179 under the CARES Act. So what we look at is 179 under the PATH Act versus 179 under the TCJA, and it's really straightforward. In this case, we don't have any weird binding contract rules. It's simply the change happens after 12/31 of 2017. Now you're in the new Section 179 expensing rules. So historically, there were two types of property that would qualify for Section 179. That was your tangible personal property and what we called qualified real property. And prior to the TCJA, qualified real property included qualified leasehold improvements, qualified restaurant property, and qualified retail improvement property. Because those were eliminated by the TCJA, that responsibility was picked up by QIPP. So beginning in 2018, qualified real property is now QIPP. But the TCJA further expanded the definition of qualified real property. It now includes re-roofing of an existing building. This had never been part of Section 179 before. It also includes new HVAC units to an existing building. Now, originally, going back prior to the PATH Act in 2016, no HVAC unit could qualify for 179 at all. The PATH Act eased up on that, and it said that HVAC units that were personal property, as opposed to real property, could qualify for Section 179. Now, under the TCJA, any new HVAC units in an existing building suddenly qualify for 179. So HVAC has come a long, long way in just a short number of years. New fire protection alarm systems and new security systems are also qualified real property now. So this is a very expansive list. Section 1245 properties, still qualifies, of course, and now that has been expanded to also include Section 1245 property in residential property. Historically, 179 did not apply to anything residential whatsoever, so no nursing homes, apartment complexes, dormitories, and now the Section 1245 property may qualify in those scenarios. This is a really, really big shift in how we look at 179. In the short run, it doesn't amount to much though, because the very things that 179 can now be applied to are also the very things that get 100% bonus depreciation right now. But when we move forward a few years and that 100% bonus goes down to 80% and then down to 60%, maybe we want to revisit this. And also it can be worth noting because there's not always state federal conformity, and so you might have some occasions where it makes sense to be aware of this because of the lack of bonus conformity. Next slide, please. So as I already mentioned, there was no direct changes to Section 179. If QIP was expensed under 179, there's no requirement to change that treatment. There are some planning opportunities, however. Due to the more favorable Section 1250 recapture rules, taxpayers that have sold or will sell buildings with QIP should amend their 2018 to 19 returns to change from expensing QIP under Section 179 to deducting it using 100% bonus depreciation. Also, the availability of 5-year NOL carrybacks to generally higher rate tax years may encourage taxpayers to amend their 2018 to 19 returns to use bonus depreciation to create a loss instead of expensing QIP under 179 and carrying forward disallowed expensing. And then finally, QIP that was previously expensed under Section 179 is outside the scope of DCN 244. To change from Section 179 to bonus depreciation, taxpayers unfortunately must amend their returns. And with that, next slide, please. Or is another polling question? I'm not sure.
We have another polling question coming up. And I'll launch it right now.
All righty. Did the CARES Act change how you approach the bonus versus 179 question? Yes, completely. Yes, but only for small taxpayers. No, or not applicable. So I'll give you another 12, 15 seconds. Michael, there's no funny quips in this series of questions.
I wanted to be serious in this section. All right, we'll give it about another 10 seconds. Getting some last minute votes in. Looks like we're all set. Go ahead and share that.
All right, yes, completely is the winner here, followed by yes, but only for small taxpayers. Like I said, there's no right or wrong answer. Thank you very much, and let's move on to the next section. So 163J. Now, the way this presentation is set up, 163J is split into 2 parts. We're going to cover the first part, which is more general, and we will not be covering the second part of 163J, which is specific to auto dealers. If you do have an interest in us diving into that, with your firm, please reach out to Michael or Al, and we can set up a further discussion to talk about that.
Absolutely.
All right. Yeah,
and you can put that in the question section of the bar, so that
sure
way
thing.
we know who to get in touch with.
Absolutely. All righty. So, at a high level, for Section 163 interest expensing, taxpayers' interest deduction is generally limited to 30% or 50% of the adjustable taxable income, tax EBITDA, plus floor plan financing interest for dealerships. There's exceptions. Non-tax shelter small taxpayers with less than 26 million in average annual gross receipts over the prior 3 years determined at the single employer level, so possibly aggregated with other related entities depending upon the complex rules. Also exceptions as electing farmers, electing real property trades or businesses, electric, sewage, gas, steam, or water utilities. There's a cost of being an exception. The utilities do not receive bonus depreciation. Those electing farmers must use ADS and do not receive bonus depreciation for assets with 10-year or greater recovery periods. Electing real property trades or businesses must use ADS and do not receive bonus depreciation on QIP. Next slide, please. The tax EBITDA limit increased from 30% to 50% for tax years beginning in 2019 and 20. Under revised code section 163 10 cap A I, this increased limit does not apply to partnerships for taxable years beginning in 2019. Taxpayers may elect to apply the lower 30% limit in taxable years beginning in 19 or 20. There's a special rule for partnerships. The partner may treat 50% of its allocable share of a partnership's excess business interest expense for 2019 as an interest deduction in the partner's first taxable year, beginning in 2020, without limitation. The remaining 50% gets carried forward at the partner level, and partners may elect out of this 50% EBIE rule. Taxpayers may elect to substitute its 2019 tax EBITDA for its 2020 taxable year 50% limitation. And then finally, Rev Proc 2020-22 provides guidance on how to make these new elections. Next slide, please. The CARES Act elections. In 2019 or 20, taxpayers may elect out of the 50% limit by timely filing an original return, an amended return, or an AAR using the 30% limit without a formal election statement is required. This is an annual election. In 2020, taxpayers may elect to use their 2019 tax EBITDA by using it instead of their 2020 tax EBITDA to compute the section 163J limit on a timely filed original return, amended return, or AAR without a formal election statement. In 2020, a partner may elect out of the 50% EBIE rule by timely filing the partner's original return, amended return, or AAR by not applying the 50% EBIE rule in calculating the code section 163J limitation. In that case, no formal statement is required. Next slide, please. (163J) DoOver elections. In 18, 19, or 20, taxpayers can file an amended return or an AAR, if applicable, to make a late election to be a qualifying farmer or real property trade or business. In 18, 19, or 20, a taxpayer can withdraw its section 163J7 election using an amended return or AAR for the year the election was made. Michael, now if you could skip over the next section, please, and go straight to section 1031. So section 1031, real property update. Okay. Historically, there have been three different approaches to how we have handled real property prior to the regs, prior to these new 1031 regs that we saw. The new 1031 regs got everyone in a panic because suddenly we're looking at personal property and trying to, and that's, we can't use that in the 1031 anymore. It doesn't, it brought forth the question of, are cost seg studies going to undermine the 1031? That's the big issue at hand here. Now, historically, we've had these three approaches. There's the state law fixture test, the maker's approach, or CCA 2012-38027. Now, many cost seg providers relied on the state law fixture test, and it bore the best results for cost seg. That was pointing out the fact that the state law definitions of personal property don't mirror the ones for under federal law, and that the understanding was that it was state law definitions that drove whether or not something was personal property under the 1031. And because the state definitions of personal property were not, did not overlay very closely with what was being identified in the federal level, most of the personal property identified in a cost seg study would be considered real property under state law. So all that conduit and wiring that we're grabbing out of the walls in a cost seg study, the exhaust systems, the plumbing, all the stuff that's personal at the federal level is not at the state level. So this is a very taxpayer friendly and cost seg friendly way of looking at it. The maker's approach was doing kind of just the opposite. And that was looking at anything that was identified as personal property under makers as being personal property for 1031 exchanges. And that means that the cost seg study would be detrimental to the 1031. And there's a surprising number of people that were relying on this, even though it was a very unfavorable way to interpret these regs. CCA 2012-38027 is kind of a middle of the road approach. In that one, most Section 1245 building components are treated as 1031 real property. Unclear results for 1245 property and non-inherently, another tangible property and non-inherently, other tangible property on a non-inherently permanent base, golly, I'm tripping up, sorry. And non-inherently permanent assets have big question marks by them. They're not well defined by this, but it's generally a favorable middle of the road approach. Now, the TCJ restricted the 1031 like-kind exchanges to real property for post-2017 exchanges. For 2 years, widely varying definitions were used, these three that I'm talking about. And our attitudes as a firm have shifted over that time, but now we have these new regs. So June 12th of 2020, the Treasury issued proposed regulations, so Reg 117589-18, to define what real property was finally. Next slide, please. So proposed regs define the real property. Real property is land and land improvements, unsevered natural products of land and water, and airspace superadjacent to land. The regs provide a laundry list of buildings, other inherently permanent structures and structural components. There's a number of multi-factor tests within these regs, and this is a hour to 2 hour presentation unto itself to go into it, but which, by the way, we do provide. Multi-factor tests identify inherently permanent structures, buildings, structural components, and distinct assets. There's guidance also provided on intangibles and interests in real property. Local law will not be or will not control the meaning of real property, except in cases of shares in a mutual ditch, reservoir, or irrigation company. So that's a big change there. That's cementing this idea that the local law does not apply. Whereas prior to these new regs, we certainly, most of us felt that local law was at least somewhat applicable. Next slide, please, Michael.
And Charles, I did want to just let you know there's about 6 minutes to the top of the hour.
That is absolutely not a problem. So there's an incidental property safe harbor. The new safe harbor for purposes of identifying replacement properties. So personal property is disregarded if it is incidental to real property acquired in an exchange. So the personal property is typically transferred with the real property in a standard commercial transaction, and the aggregate fair market value of the incidental personal property does not exceed 15% of the aggregate fair market value of the replacement real property. The safe harbor is for ID purposes. Personal property will still cause boot. That's important. Okay, and now to what is really my final slide. Next slide, please.
Actually, Charles, let's throw in our last polling question.
Sure.
So we'll get this one out.
Michael, you typed too quickly. Will you advise taxpayers to perform cost segregation studies, even if it might create some boot? Yes, no, yes, but only in certain situations, or not applicable. And again, we'll give you 12, 15 seconds or so.
So not another entertaining choice for an option, but an entertaining point in the question.
Darn typos.
All right, we'll give everyone just a couple more seconds. We'll go ahead and close it out.
Yes, but only in certain situations is the clear winner here. But again, there aren't any right or wrong answers. So move on to my final slide. So what I want to do here is illustrate a cost seg study and its impact on the Section 1031 exchange. So in this case, we're looking at a restaurant. And inclusive is the FF&E. So this is a very, very target-rich environment. And with the normal cost seg study, we start off with general costs, from the contractor, for instance, building shell, HVAC, millwork, et cetera. We break these down into our property units, which are groupings of costs based on their tax treatment. So for instance, computer electrical or kitchen electrical, decorative lighting, et cetera. And as we move to 3/4 of the way through the slide, we see the allocation for cost seg purposes. In this case, 53% is real property, 22% is 15-year real property, and 25% is 5-year personal property. But these are under the normal federal guidelines. When we apply all those multi-factor tests, which we didn't get into on in the 1031 discussion, what ends up being personal property is only 14% in this example. Now, that 14% is important because that would still seem to be causing problems for us. However, this slide here doesn't include land. And once you throw in the land cost, then what would be remaining as personal property, it would probably be down less than 10%, might be closer to 5, 6, 7%. That's personal property, which ends up being pretty insignificant, all things considered. And so when we're performing a cost seg study, if we are told that there's a 1031 exchange involved, now either, and this can happen a couple ways, sometimes in the process of an exchange, someone chooses to perform a last minute cost seg on their older property. Sometimes we're doing a cost seg study on the new property, sometimes both. Sometimes the cost seg study was performed years ago on the original property that's being traded up. It can happen a number of different ways. But when we are in a scenario where we're trying to figure out the impact of the cost seg study on the 1031 exchange under the TCJA, what we do is we create two separate sets of schedules. There's what's personal property in the traditional cost seg study under the federal rules for personal property. And then we will create a parallel schedule that is specifically defining the personal, that's identifying the personal property as identified by these new 1031 regulations that have just come out. And we've already done a number of these, and it works very cleanly. And you'll see that the personal property, even with a really target-rich environment such as a restaurant, ends up being rather minuscule by the time we finish with that. So with that, that's my final slide. Michael and Al, do you want to sign off? Take it from here?
Yeah, thank you, Charles. And thank you everyone again for joining. I know that was a lot of packed in information. We did receive several questions from the attendees, and we will get to those via email from either one of us. Again, my name is Michael Wardy and Al Schmidt. We appreciate you joining us. One final closing statement is that Source Advisors, we spend our time working closely with CPAs and our clients, making sure they're going through the right process and the right consideration when looking at cost segregation, as well as R&D and LIFO. So we look forward to relationships with some of the attendees that we have and look forward to a successful and healthy 2021. Thank you again, everyone, for joining.